Every Monday to Friday, this is Peter Lewis's Money Talk. Money Talk.
Good morning, this is Peter Lewis, welcoming you to my podcast Money Talk for Wednesday the 28th of June. This is the original Money Talk and it's sponsored by Surfing Group, which is headquartered in Singapore and offers online financial services to 30 million customers across 10 countries. You can find the show on Apple Podcasts, Google Podcasts and Spotify, where we're one of the most listened to financial podcasts in Hong Kong. Also, please take a look at my daily newsletter, which you'll find at peterlewismoneytalk.substack.com. In today's business and finance headlines, Premier Li Qiang expressed optimism over the mainland economy yesterday. In his opening address to China's annual meeting of the new champions, known as the World Economic Forum's Summer Davos, Mr. Li said China was still on track to reach its annual growth target of around 5%, with growth in the second quarter expected to be faster than it was in the first. Premier Li said the nation would roll out more practical and effective measures on expanding domestic demand and stimulating market dynamism. But Premier Li warned that governments that attempt to politicise their economies will only fragment the world. He said the invisible barriers put up by some people in recent years are becoming widespread and pushing the world into fragmentation and even confrontation. He added we should oppose the politicisation of economic issues and work together to keep global industrial and supply chains stable, smooth and secure. He described the Western concept of de-risking as a false proposition. ECB President Christine Lagarde said Tuesday that inflation is still too high and it's too early for the central bank to declare victory over consumer price rises. Speaking at the Sintra Central Banking Conference in Portugal, she said we've made significant progress, but faced with a more persistent inflation process, we cannot waver and we cannot declare victory yet. Official data released on Tuesday showed that Hong Kong's trade recorded the largest decline in 4 months. Exports slipped 15.6% year on year and were down for a 13th consecutive month. Imports shrunk at a much faster rate of 16.7%. That's the 11th straight monthly contraction. On today's programme, I'm joined by Mark Michelson, Chairman of the Asia CEO Forum at IMA Asia, and Alex Frew McMillan, a freelance writer and Asia columnist for TheStreet.com. And with a view from South Korea, it's Peter Kim, Managing Director and Investment Strategist at KB Securities in Seoul.
Peter Lewis's Money Talk.
On Wall Street Tuesday, technology shares reversed Monday's sharp falls as investors readied for the end of the first half of 2023. The S&P 500 advanced 1.2% to finish at 4,378. The Dow rose on Tuesday for the first time in 7 days, climbing 212 points or 0.6% to end at 33,927. The Nasdaq Composite surged 1.7% to settle at 13,556. US Treasury yields rose on Tuesday ahead of the Personal Consumption Expenditures Index for May, which is the Fed's preferred measure of inflation, due on Friday. The 10-year Treasury yield was trading at 3.75% after rising by 5 basis points. The Japanese yen slipped below 144 against the dollar for the first time since November. The yen is down 10% since the start of the year, and the yen is approaching levels at which the Bank of Japan intervened last year to support the currency. The offshore yuan rebounded after China set its daily reference rates for the managed currency at a stronger than expected level for a second day. The offshore yuan rose 0.33% to 7.2240 renminbi per dollar, while onshore yuan was at renminbi 7.2193. On Monday, the yuan fell to a 7-month low of 7.2364 in Shanghai. The renminbi is more than 5% lower against the dollar this quarter, and that's put the currency on track for one of the worst quarterly falls on record since the country ended a soft peg to the US dollar in 2005. Chinese stocks rallied Tuesday after Premier Li Qiang gave a speech at the Summer Davos, indicating that authorities intended to support growth in the world's second largest economy. The Hang Seng Index, which was down for 5 straight days, losing 6.2% over the period, recovered 354 points, or 1.9%, to end the day at 19,148. Hang Seng futures are unchanged this morning, signalling a flat open for Hong Kong's benchmark index. On the mainland, the Shanghai Composite Index climbed 1.2% to 3,189. And you can get more details on the latest market movements in my daily newsletter, which you'll find at peterlewismoneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
Let's welcome our Wednesday morning guests. We have with us Mark Michelson, Chairman of the Asia CEO Forum at IMA Asia. Morning, Mark.
Good morning, Peter and Alex.
And also with us, Alex Frew McMillan, a freelance writer and Asia columnist for TheStreet.com. Morning to you, Alex.
Morning, Peter.
Let's start with Premier Li Qiang's opening speech at the new meeting of the new champions. It's known as the World Economics Forum's Summer Davos, the first in-person meeting in 3 years. Premier Li Qiang gave a keynote speech. First of all, he spoke about the economy. And he said China was on track to reach its annual growth target of around 5%. And he said growth in the second quarter is expected to be faster than it was in the first. China's economy, as a reminder, grew by 4.5% in the first quarter. Premier Li said the nation would roll out more practical and effective measures on expanding domestic demand and stimulating market dynamism. And he said China will also continue to be committed to a more open economy. Mark, what do you make about that? Because economists may be a little bit surprised because their feeling is, certainly from the anecdotal data and from the forward-looking data, is that growth is slipping in the second quarter, not improving.
It seems to be. Of course, we're all hoping that he's right, and the Hang Seng Index reflected that, but maybe has come down to earth, it sounds like today. And the reason is, of course, one of the reasons is because China is absolutely vital to the Hong Kong's economy prospects as well. And we've seen issues there with exports and other areas. Those issues are still there in China. Certainly the stimulation measures may help in certain areas. It may not be enough. Still problems in property, still problems with local debt, still problems with consumption in terms of confidence of consumers and wanting to spend. Doesn't mean it's still going to be a pretty good economy, I think, compared to much of the rest of the world. But at this point, it looks still below expectations. Again, I hope the Premier is correct.
Alex, were you surprised at all by what he said?
Well, I'm not surprised that he's attempting to talk things up. I guess the point is that both compared to its historical norms and to other emerging markets in Asia, particularly India, China's growth still looks lackluster. And I think, as market pundits like to say, the risks are to the downside. So, Nomura, S&P, they've been cutting their forecast for China growth for this year and sometimes next. And it certainly looks to be well off the pace that, we're seeing in India, where the economy is growing at about 6.9%. So let's not forget, too, that this year's numbers in China are buffed because last year was so poor because they were still attempting to wipe out COVID. So the comparisons look pretty good in 2023 because last year was very poor. But services is what's really sort of keeping the ball rolling at the moment in China, and manufacturing looks quite dismal. And we saw that services tourism spending over the Dragon Boat Festival weekend, for instance, was generally disappointing. Car sales seem to be down, home sales are not good. So it looks like the Chinese consumer isn't expressing a lot of optimism, although they're accounting for the growth that we're seeing in these numbers.
And we're going to find out on Friday, because we'll get PMI numbers, which will tell us a bit more about how the manufacturing and services sector are performing. Mark, Premier Li was talking about taking measures to support the economy. This is like waiting for Godot, isn't it? We've been waiting for these stimulus measures for quite a while now, and they just don't seem to be coming.
Well, they've started it to some extent as well in terms of lowering rates and sending signals of support in areas like property and so on. And it's something that's probably needed, but again, it doesn't look like it's going to be enough. Our forecast it remains, and we may be wrong, is that growth for the entire 2023 is going to be below 5%, and maybe around the 4.6% level. That's a little lower than most forecasts, but it indicates that there are still issues, all the ones that Alex outlined.
Do you think, Alex, the market rally is not going to last unless we do see more than just talk? I think investors, economists want to see, well, okay, what are the concrete actions that Beijing is going to take to try and support this economy? Do you think there's any chance that we're going to see some concrete actions, and what sort of things they could do?
Well, as Mark just said, we have seen, a sort of 10 basis point cut in various rates, short-term, mid-term, which is kind of as small as it could be, really, in terms of a change. So they're sort of stuck because they want to stimulate the economy, and then they're very wary of inflating asset bubbles again, which is what's happened in the past when they've introduced stimulus. So they're sort of really trying to target that stimulus as carefully as they can. So I expect we would see various cities maybe, allow people to buy more homes and adjust the mortgage down payment requirements, especially for first-time buyers. Those are sort of changes that tend to be quite easy to make and perhaps don't lead to a huge boom in the property price, which is what they want to avoid and what happened last time they introduced large-scale stimulus. So, they're sort of stuck. And I thought it was very interesting that the Chinese Communist Party gathered recently, executives and entrepreneurs and kind of asked them, what can we do to get the economy back on track? Because it's been a lot of moves by the CCP that have effectively shaken confidence by making sudden changes overnight that affected industries drastically, targeting big tech and the most successful companies in China. That's really shaken a lot of executives and business owners' confidence. And so that's going to be very hard to restore. And I think consumer confidence is also not strong. Those are both difficult things to reestablish.
Okay.
I think it's possible that more important measures might come out of Portugal than Tianjin this week.
Where
the central bankers and European central bankers are meeting.
Yeah, we'll get onto that in a moment. Let me ask you about another aspect of what Premier Li talked about, and that was that he really went on the offensive against the Western concept of what they call de-risking. He said, as you know, some in the West are hyping up the so-called phraseologies of reducing dependencies and de-risking. He said these two concepts are false propositions. As economic globalization has already made the world economy an integral whole, where everyone's interests are closely entwined, countries are interdependent, interconnected with each other on their economies. And he said we can enable each other's successes. But he warned that governments that attempt to politicize their economies will only fragment the world. The invisible barriers put up by some people in recent years are becoming widespread and pushing the world into fragmentation and even confrontation, he said. And he said we should oppose the politicization of economic issues and work together to keep global industrial and supply chains stable, smooth and secure. And he said that business decisions shouldn't be subjected to geopolitical confrontations. Now, Mark, this is quite a robust attack, isn't it, on this whole idea that's come up recently of what the West likes to call, I think Ursula von der Leyen invented the term, de-risking.
Yeah, well, and you've heard the distinction made between de-risking and decoupling by Secretary of State Blinken and others. I'm not sure there's a difference. It's semantic difference, but not much else. But it's going on. It's going on, and not just by governments, but by companies. And what they're trying to do, obviously, is diversify to somehow protect themselves in terms of supply chains and others. Part of it has to do with cost. Part of it has to do with geopolitics. And there are other issues as well. It's going on, not always too successfully. And, strangely, it's also going on now in South Asia with garment makers, where demand has come down for garments, especially in the United States and to some extent in Europe. And that was the de-risking place as an alternative to China. And now they have to think again. So it's evolving. It's partly political, but it's partly not political. And to say that economics is being politicized, I don't think that's new. I think that's been going on for a couple of thousand years at least.
Alex, what was interesting about this was they seem to have a bit of a new strategy here. They seem to be trying to drive a wedge between corporations and their governments. They're basically saying this should be left to companies to decide. They should decide what is meant by de-risking and how to manage their risks, and governments should really step out of the way, which I suspect will be music to some companies' ears, actually. That's exactly what they are doing. I mean, companies in Germany are sort of almost defying the governments by investing in China in certain sectors that Germany is worried about. What's the significance of this new strategy?
Yes, I think appealing to companies is much easier for a government like China, and likely to be much more successful. And principally, I mean, they have leverage over companies. If you've got a factory in China, as Micron has discovered, and there are geopolitical tensions, all of a sudden Micron's under investigation, we found some flaws here and there, so they can target you if you've got a production facility in China. But we have seen, Tesla, Mark Mobius recently sort of saying that they like India and want to enter India, while still being bullish on China. So I think that's the difference between de-risking and decoupling. I think there is a difference. It means, we'll stay invested in or manufacturing in China, but we're going to diversify. And normally India seems to be the first place that people look, multinationals look, and investors look. I've written a couple of stories recently about, is China the new India, and there's a lot of interest. I get a lot of emails from readers in the US asking about India. Friendshoring is a real thing. I think companies are looking to expand production in allies of the United States, and there's a growing number of investment funds that exclude China or exclude the sanctions-bound companies, which makes things problematic for investors into China. So I think it makes sense for China to appeal to companies, and they're more likely to find success there. They don't have leverage over the US government, really. It is true that, German companies and so on are still very keen to expand in China. But I think, as Mark was saying, the pandemic revealed the issues behind having too much production in one place and having all your eggs in one basket. So, just if there's a natural disaster, for instance, that can disrupt your production lines, it helps to have production in the second, the third, and the fourth location as well. And so I think companies will still keep de-risking in that way.
I agree. And India, Micron's a good example of India being attractive to other companies as well. In terms of decoupling, it doesn't mean completely going away from China. Most of our members in China are committed to China one way or another, but again are trying to put their eggs in other baskets. Also, part of it's a reaction to customers in China who are tending to try to de-risk themselves, whether for political or for economic business reasons, and try to depend more on local suppliers than international ones, thinking that might be reliable in the longer term. And then those companies that are international companies who were their suppliers have to look for other customers.
What I find ironic about Premier Lee's comments is that China's the world leader in politicising companies. I mean, it would never stand for the idea that its own companies should somehow operate independently of the government and shouldn't be serving overall government objectives. So, but nevertheless, this seems to be China sort of trying to redefine de-risking towards its own ends.
Yeah, and state-owned enterprises, which, not only in China but elsewhere, are one of the issues for the WTO and for others in trying to look for new ways to regulate or reestablish some form of an international order. With these mixed successes being kind.
Alex,
we saw with when Carrie Lam was in charge, she kept saying don't politicize things, which basically just meant don't disagree with me. It didn't mean don't make it political. And China, has just banned three financial writers, for instance, from Weibo because they've been writing, that the stock market's not doing well. They expressly said that they've been attacking and undermining policy. So they've politicized it right there. And I agree. I mean, they 100% politicize almost everything. So just saying don't politicize things means, please don't target us and disagree with us.
This is a worrying trend, isn't it? If it is a trend of banning sort of economists, of banning financial pundits, if they say negative things about the economy, or I think in this particular case about the youth unemployment rate, presumably this is partly a reaction to the fact that the Chinese market has performed so badly this year.
Yeah, and it's the real worry that people have had about, having analysts based in Hong Kong, for instance, with the national security law in place. Can you be arrested for saying that the Chinese economy is not being managed very well, or that the stock market's doing poorly? Is that sedition? Perhaps,
Mark?
This isn't new, but the trend is worrying. I remember about at least 15 years ago, could have been longer than that, an economic analyst in Singapore revealed some data. I think it might have been GDP data a bit early, and it was not favorable, and was taken to task by the government, and the government wanted to deport him for releasing that because he was not a native Singaporean. This is the sort of thing that happens, but it just seems to be increasing, not just in China but elsewhere, and that's a worrying trend.
Where do you think this is all heading as we move into the second half of the year, this idea of de-risking and securing supply chains? We've got talk of maybe Janet Yellen visiting Beijing at the beginning of July, but also talk at the same time that Joe Biden's pushing forward with an executive order that could cut off certain US investments in China, particularly in chip making, artificial intelligence and so on. So if you look at that, it doesn't seem that things are going to improve, does it, in the second half of the year?
They're mixed signals, right? And that's a really good example of that. And, it's not just tech companies that are worried about that. U.S. tech companies and others, and some even based in Hong Kong, there are other industries that you would think are less sensitive to these kind of trends because you don't know how far it's going to get and how that's going to affect U.S. relations, especially with Hong Kong and the Hong Kong Policy Act and all that sort of thing. But on the other side is Janet Yellen, who's been the most vocal in suggesting that the U.S. restrictions on China, especially in tariffs and so on, are often counterproductive, and has raised other issues which I think many people would sympathize with, especially in business. And if she does get to China in July, I guess that's a positive sign, and it would maybe be followed by others, both U.S. officials going to China and Chinese officials maybe going to the U.S. as well. That's not going to solve everything, but at least it may ease the situation for a while until the U.S. political system kicks in full throttle, which maybe is already happening, but especially will ramp up as the autumn approaches.
Alex, if we look forward to the second half of the year of these geopolitical tensions, do we have reason to be optimistic that maybe at least the two sides can learn how to live with each other?
Well, it's been interesting that the U.S. has been, restricting, chip exports, things like that to China, while, requesting all sorts of ministerial meetings and sending Antony Blinken and possibly Janet Yellen to China. So they've been reaching out, on the bureaucratic level and political level to China to try to reestablish dialogue. But I think, the sentiment in the United States against China is quite negative. I was just reading that it's very similar to how Russia was viewed after World War II, where immediately after World War II, Russia had been a U.S. ally, so it was viewed quite positively. And then that changed quite quickly and became a very negative view going into the Cold War. And China is now sort of viewed in a similar light in the U.S. And then that feeds into the political system, and politicians see that they can get votes by attacking China or have that part of their platform. So, we'll be going into an election cycle in the US. So I wouldn't see them ratcheting the rhetoric down any. I think that'll continue, while at the same time there are these efforts to politically, at least, make some connections, re-establish links, which China often actually cut off. They cut off the means of the two militaries discussing situations so that they could avoid, getting into clashes and so on. I think the US would like to re-establish a lot of ministerial connections.
Let me ask you.
But going into the second half of the year, I'm sure that this political tension is going to continue, and I think those, de-risking trends will accelerate. They've been going on, since before the pandemic, but then the pandemic really kind of pushed it to the fore.
One of the issues in the U.S. is the China issue is not often decisive in elections, but you can't step off the central narrative, which Alex just outlined, of worrying about China and being a threat to the U.S. And if you do, then you're in trouble politically for politicians of either party. So that's the issue. And as I said, I'm afraid it's going to ramp up probably as we approach the end of the year rather than calm down. I hope I'm wrong, but I think I'm not.
Before we finish, I just want to get a quick comment from you both on Hong Kong trade, because trade has fallen by the most in 4 months, according to official data released yesterday. Exports slipped 15.6% year on year. That's the 13th consecutive month of declines. And for the first 5 months of the year, the total value of shipments declined by 16.3% compared to the same period a year ago. Imports shrank even faster. They were down 16.7%. That's the 11th straight monthly contraction, and it means the trade deficit increased in May to 26 the trade deficit decreased in May to $26.4 billion. Commerce and Economic Development Secretary Algernon Yao said, "We hope to find a way out through cooperation with different trade blocs and overseas trade delegations for business opportunities." But that's easier said than done, Mark, I suspect, isn't it?
Yeah, we're trying to join RCEP, for example, the Hong Kong government, and whether that would make a big difference since that organization is just getting started, I don't know, but I'm not sure even where that is. Yeah, exports obviously is a major problem. Plus the other issues, as I mentioned earlier, obviously Hong Kong's pretty dependent on the Chinese economy, and if the Chinese economy doesn't perk up a little bit more, obviously it'll have an impact on Hong Kong. Again, Hong Kong will do better almost certainly than it did last year, but again, maybe not reaching the expectations that many had hoped for.
Alex, your thoughts?
Yes, a lot of those trade numbers for Hong Kong imports and exports are going into and out of China, whether it's sending components into China to be assembled into parts, and then the finished product comes out through Hong Kong and is shipped elsewhere. So it's intricately tied with the Chinese economy.
Okay. Well, thank you both for your thoughts this morning. Have a great day. That's Alex Frew McMillan, who is a freelance writer and Asia columnist for TheStreet.com. And you also heard Mark Michelson, who is chairman of the Asia CEO Forum at IMA Asia.
Peter Lewis's Money Talk.
I'm joined now by Peter Kim, who is managing director and investment strategist at KB Securities in Seoul. Good morning to you, Peter.
Good morning.
I wanted to get your thoughts about the first half of the year in markets and in the economies as we move into the second half of the year next week. I think there's been three big themes, hasn't there? The first one has been, of course, inflation. Central banks raising interest rates a lot more than what people anticipated at the beginning of the year. And it looks like, if you listen to Christine Lagarde yesterday speaking at the ECB banking conference, in Portugal, they are not done, and the Fed is not done either. Do you think investors are prepared for this in the second half of the year?
It seems that way. If judging by the very strong rally we've seen from U.S. equities, it would seem that there is a return of animal spirits of a certain scale. And despite the data warning of impending recession, the investor appetite has been very strong. I think from beginning of this year to now, perhaps the biggest difference or change has been, rather than whether there is a recession coming or not, I think the more focused and relevant question would be what type of recession. And I think the rally in equity market seems to signal that from what we thought at the beginning of the year to be a deep and possibly very destructive recession, now we're looking at a shallow and perhaps short one that we can actually manage through. And I think that is being reflected in the rally in U.S. equities, despite, the worrying signals elsewhere outside of the U.S., to be frank.
Do you think central banks have got on top of inflation? And I suppose it depends to a certain extent where you look, doesn't it? Because maybe in emerging markets, and particularly here in Asia, central banks do seem to be on top of it. They're pausing now the interest rate rises, but it doesn't seem to be the case in the developed markets, certainly not in Europe and the UK, not in the US, and not in Japan either. If you look at the recent inflation data there, it's at a 40-year high.
Yeah. I think it's, once again, we need to look at it from, let's say, September of last year. Like hyperinflation, energy prices going to the moon. I mean, it seemed like there was a implosion of a massive kind. And now inflation is still there. And I think the best way to describe it is sticky. It's not going away, but it's certainly not at that worrying level that we saw back in September. So I think, once again, from September to now, inflation is under control, but under control does not mean it's gone. So I do think that there is a lingering component of inflation that probably a good prolonged recession can only resolve.
Do you think maybe, as maybe the chief economist at the IMF was suggesting earlier this week, we've got to get used now to a period of higher inflation? That maybe is a risk that we're going to have to take, because it's going to be extremely difficult without very painful interest rates to get inflation back to the central bank's targets.
Yeah, well, I think, again, we need to be a little more nuanced. Sustained level of higher interest rates, what would that be? 3-4%. Historically, if you look at over the past 30 years, it's not painful. Inflation of 2-3% is always something that is considered healthy. So I think maybe real interest rate with inflation adjusted, if 1 or 2% doesn't seem that drastic. And I think we can live with that type of an environment for a couple of years. And I think we are, and there's certainly equity market is adjusting to that reality. That is not, we don't have to have some sort of a catastrophe with inflation running at 2-3% and interest rate running at 3-4. That's real interest rate 1 or 2. I mean, I think that's manageable. And certainly from a corporate debt management standpoint, that's certainly manageable over a longer period.
But you have places where, like the UK, for example, where you've got inflation much higher than that at 8.7%, the headline inflation rate, and no sign of it coming down.
That's right. So I think I call it the decoupling from the US from rest of the world, certainly against China. But when I was in Europe a couple of weeks ago, I mean, the investors there were basically stating that recession is here for Europe, and they're, sorting it through. So I think U.S. Is probably standing the strongest with its onshoring efforts, its inflation, the oil prices working in its favor. Shale gas certainly playing a part in that. So, to be honest, I think there is a very understandable justification for U.S. equities are performing versus the rest of the world. And certainly against EM, it's definitely the decoupling is certainly looking a lot more profound.
Do you think that outperformance of US equities, which has been driven largely by technology stocks, and in particular those related to artificial intelligence, and then when you compare the China markets, which are the global underperformers this year, do you see any sign of things reverting?
Well, it's a technical speaking, it's certainly due for correction, and we're seeing a very small part of it now. But I think it's wrong to describe what's happening with the AI themes in the U.S. to be one-off, isolated rally. I think it's a function of a broader strengthening of the macro structure of the U.S. And that compared to the earlier this year, U.S. economy is managing it pretty well. I do think that there is going to be some weakening of the U.S. economy in a few months. Some of the data that I'm watching does seem to signal further weakening, which I think will probably prompt concerns of a recession. I think, once again, what type of a recession is going to be the focal point rather than whether a recession is coming or not. Looking a little bit into China, I do think that there's some worrying concerns that the policymakers from mainland has not really gotten behind the reopening and stimulated to create a much bigger momentum. Certainly, the lack of consumption returning from zero lockdown relaxation signal an economy that really is on a weaker foundation that the policymakers expected. And I do think that part of it is the political environment, which is chilly towards that, the exuberant consumers that used to just go out and spend. And also, I think the geopolitical risk hitting corporate investment sentiment as well.
And where does South Korea fit in? The markets there, they've been quite resilient, haven't they? And of course, you have got some artificial intelligence champions there as well. So does this make South Korea an attractive proposition?
Yeah, I think I wouldn't call them champions yet. It's short history, and there's a lot of wannabe champions out there, and Korea is very quick to make adjustments. South Korean companies are always underestimated for its ability to adjust, pivot based on changing trends. And you look at the history of Korean companies, they are very, very good at it. And I think in an environment where you have changing macro environment as well as geopolitical and technological, Korea's usually come out with some beneficiaries. So that definitely I do believe in. From a broader macro standpoint, Korean economy is holding pretty well. Its central bank, the BOK, was one of the first ones to hike about 6 months before the FOMC, so it has that advantage. And secondly, unlike the U.S., we don't have labor shortage at the mid-end or the low end. So the lack of perhaps a manageable wage inflation is certainly in its favor. And the fact that the commodity prices and oil prices is coming down, as a net importer of all those resources, South Korea is a reasonable beneficiary, unlike the rest of the EM. Yeah.
Okay, interesting. Now, the third theme, of course, from the first half of the year is the geopolitical one, what the West calls de-risking from China. It's changed its phraseology from decoupling to de-risking. It was interesting yesterday at the Summer Davos that Premier Li Qiang made a robust rebuttal of that. He was saying de-risking was a false proposition and it was just going to fragment and divide the world. But no sign of that ending, is there?
No, I think it seems like both U.S. and China are hunkering down for a long period of this standoff. And every time you have a little bit of green shoots of reconciliation, from another place, escalation starts. So I don't think it will end anytime soon. South Korea is an interesting country because it's always been tasked with managing the two sides pretty well in its history. Increasingly dependent on China, but politically always aligned with the U.S. And I think how South Korea manages this situation might be a useful blueprint for other countries, to be frank. But there is one country that I just noticed that is managing it even better, and that seems to be India.
India, yes.
And that's something that I find very interesting. I mean, they seem to be doing it much better than anyone else, It's managing its political neutrality, but having the benefits of economic proceeds equally as well. So, it seems to be maybe it's the new champion of political and economic neutrality.
Narendra Modi is walking the tightrope very well, isn't he, between the West and China?
Very impressive.
Peter, always a pleasure to talk to you. Thank you very much indeed for speaking with me this morning.
Thank you.
That was Peter Kim, Managing Director and Investment Strategist at KB Securities in Seoul. Thank you very much for listening this morning. Don't forget to take a look at my daily newsletter, which is at peterlewismoneytalk.substack.com. On tomorrow's show, I'm joined by Andrew Ferris, the CEO of Econosis Advisory, and Louisa Fock, China Equity Strategist at Bank of Singapore. With a view from Taiwan is Ross Feingold, Business Development Director at SafePro Group. Please join me again tomorrow.
Money Talk